and welcome. You're watching The Investing Edge. I'm Sumera Abdi. The process of money used to be called the art of investing. Well, there is reason enough to now call it the science of investing. Scientifically managing your money is the way of the future. And at Investing Edge, it is our endeavor to provide you with the best practices in this domain. With me this evening, I have Mr. Anand Rathi, who's the chairman of the Anand Rathi Group, and Feroze Azeez, who's the deputy CEO of Anand Rathi Financial Services. So, gentlemen, thank you very much for being a part of this show. We're in Dubai this week. And Mr. Rathi, I want to actually begin with a larger question, not on wealth management, but on the environment that we're living in. Now, you're a man who has seen many market cycles. You're a man who's seen many environments changing, whether it's political or economic. What's the sense you're getting of whether things are headed for the worse or for the better?
Looking at the economy, obviously, everyone knows, and no one knows better than people in Dubai, that economy is passing through difficult times globally, and even I'll say in India. It's not, the expectations which are there. You've seen the last 6 months, the targets have been revised perhaps 3 times, which has not happened before. Politically, obviously, India has the advantage of a really very, very strong government. We saw that if government wants to do something, it can do. And the last, tax reduction step which the government has taken, I can tell you that no one perhaps sitting here or in India even expected that India can have a tax rate of 15%. So, if you see the positive side of it, I think government is very strong and capable of taking difficult decisions. So I believe that political situation in India is good. Globally also, political situation is becoming more protectionist. You can justify, you may not justify. They are very different thoughts. But I think, let's face fact that everyone wants to protect their own citizens' interest. I think जब खरा समय आया तभी अच्छा लगेगा कि अब अच्छा आएगा. After every night there is a, sunset, there is a sunrise. I believe that at least for India, the situation, the conditions are very good. The potentials are very good. We are seeing a continuous spell of very low inflation. Their interest rates are coming down, which I think is one major requirement for any economy to grow. I think what the Indian economy has suffered in the last few years has been tightening of liquidity by the central bank. Personally, to my mind, that was not warranted. The interest rate increase which were made few years back were not warranted. But central banks work differently. But now there is a globally very clear indication coming that liquidity will be increased, interest rates will fall, and I think when that happens, there is an economic cycle. When the interest rates, inflation fall, liquidity increases, the asset prices will go up. And therefore, I think you see the wealth effect when these things happen.
Okay, so let me throw another thing into that mix, Mr. Rathi. If things are on the up and up, could there be a further advantage? We heard Prime Minister Modi in New York say that he is looking to bring equity taxation in India at par with the global standards. Now, perhaps it could be LTCG, which is the long-standing demand. Perhaps it could be in some other fashion. But could that be an orbital shift for the market?
Yes, if that happens. I think, to my mind, many steps which have been taken in the past on LTCG were not warranted. Dividend tax, there has been continuous demand that we can't have double, triple taxation. And I think over a period, I know when I was president of BSE, we talked of LTCG. The government removed it and brought it the STT. Now what has happened over the period? STT has been increased and LC has been reintroduced. I think that is something which obviously markets don't appreciate, investors don't appreciate. Agar 5 trillion lana, तो I think lot of reforms are needed. This time the government is in far stronger position to do these reforms than last time.
All right, touche to that. But Feroze, now let's drill it down to investments. Diwali is around the corner. and everybody wants to see a little bit of green on their screen. Therefore, is there any advice on the market? Should people be looking at direct equity now, or are mutual funds still the best route for people to take?
I think these are times where you manage risk far better. You can't just be buying anything. You can't be buying products and assume that they will fall all in place along with each other. Point two, having a strategy in place. What do you mean by a strategy? A strategy is a well-tested combination of products which work along with each other. Now, for example, we recommend one strategy to our clients, which is called the standard strategy, which we love our clients to follow. Because we have tested it for the last 25 years, we have tested it for the next 25 years using simulators which are available. The point I'm trying to make is, if you have tested 10 strategies for 50 years and then chosen one, right? So that's a strategic approach. So my only feedback is, external factors are not in our control. We are puppets to external factors. But there are some things we are in control of. If we don't even control them, then it's ironical. How do I come to what should I buy? See, there's plan A and plan B, like we just spoke. In the plan A, there is plan A1, plan A2, plan A3, plan A4. Buying stocks yourself is one thing you can do to get the benefit of a growing India, corporate India. Buying stock yourself, buying mutual funds, buying PMSs, portfolio management services, or buying alternate investment funds. These are called AIFs. These are the four vehicles. Once you have your strategy in place, you will have to make a choice of the vehicle to get into the market, right? So which of these four are good? The good part is, data can give us this answer. After doing a relative comparison for the last 10, 15, 20 years, on a risk-adjusted basis, it was clear that mutual fund wins hands down. PMSs are obscene at risk, obscenely high risks. Okay, AIFs not tax efficient. So if you take all the four different parameters on which a product should fare very well, mutual fund will be a better plan A, is the conclusion. Of course, anybody can seek the data for the conclusion I've just given you. For the lack of time, I'm just giving you the conclusive comment rather than taking you through the process to come to that conclusion.
Okay, so now I had some friends in Dubai, and I've heard that leverage products are very, very popular over here. So since we're here this evening, let me ask you that for leverage products, what are the risks?
So leverage as a concept is very popular here. Leverage, by which I mean I put my $100, the bank gives me 500 more, and then I have 500 to invest. I pay the interest because the interest rates are low enough, and still make more money. So when you take leverage, there are three important risks you have to keep in mind. The most important risk which hit my client very hard is that if your income and liability has to be either fixed or both should be variable. Now let me explain. If you buy a product like an SBI bond quoted here, let's assume 4%, 5% is the interest, right? That's fixed 5%, right? If you take a loan for 5 times your money and the interest rate there is not fixed, then it's a very big risk. Okay? So if your liability is fixed, your income should be fixed and your liability should be fixed. If you don't do that, then you can wash away your entire capital within no time. Second risk is the margin risk. Okay, why am I saying this? Quite a few. And margin risk is a risk which is called a low probability, high impact. See, there are some risks which are so low probability, 1% chance. But if that 1% happens, you lose it all, like a plane crash. Right? The chance is very low that you will crash, 1 in a million, but if it so did, you will not go scot-free with a broken bone. You're sure to die, more or less. Leverage in any form should be restricted to not more than 20%. Okay, that's the rule which we put for our clients. that if you have 100 rupees, you can borrow 20 rupees. You can't have 100 rupees and borrow 500 rupees.
Whenever we've had this event, you've always listed out that, you should, a return should be an objective, right? And you put a number to it. Say in Indian rupees, it's 15%. Now, how wise or how possible is it to have a double-digit dollar return?
Keep an objective number target, gives you clarity in decision making. Now, like yesterday, my brother lives in Dubai, he moved from UK as a citizen. So he's telling me, one of my friend is doing an e-commerce business, would you want to put 1 crore in it? Okay, then I visited my objective and said, my objective is to make 17% on my money, right? So if I have to make 17%, do I need to invest in a startup e-commerce business? The answer is no, right? If my objective was 28, then I would have definitely got my antennas up to understand what the business is. So objective, once you have an objective, decision making becomes that much simpler because everything has a context. Okay, does it help me meet my objective, right? Or doesn't? So coming back to the point, 15 is possible with very low probabilities of loss and value at risk of 10%, 12%. Value at risk is the maximum loss possible. If 2008 to the power 2, but if those are 8 was a very, very bad year. If that kind of year comes with twice the magnitude, what will happen? You will lose 12-13% of your capital. That is called value at risk. So these are the two risks. So with this kind of value at risk and this kind of probabilities, I call this as low risk. Some people say, no, this is also not low risk. I want it lesser. Then you change the strategy. Fortunately, 3 years back, 2.5 years back, National Stock Exchange, which is the largest exchange of the country, helps you on his platform or her platform, helps you hedge the dollar at a cost of 3.8 to 4%. By which you mean, if you paid 4% every year and you made 14% in rupee terms, 4% is your cost to bring it back to dollar, you will lock in a 10% dollar return. So it is possible to make 9%, 10% is a little stretched, 8 to 9% dollar return with risks of 7.5 and value at risk of 13 is possible.
On that note, we'll take a very quick break. We'll be right back. And on the other side, we're going to open up the floor to questions from our audience. Do stay tuned in. Welcome back. You're watching The Investing Edge. This week's special comes to you by, and we have a lovely audience who have a lot of questions for our two experts. So let's take the first set of questions. I have one question from Mr. Mishra, who wants to know about investing in fund of funds or international markets. Okay, so go ahead.
Yeah, Feroze, I was asking you whether you would have a view about fund of funds through the Indian market which invest in the US or international markets.
Okay.
That's a very cheap alternative to invest in the US market when I'm based here in Dubai. So I would also like to know from you, should it be a considerable portion of one's portfolio?
Yeah, so I think you're referring to feeder funds, not fund of funds. Feeder funds is what they're called. So feeder funds are nothing but funds based in India. They collect the money and they feed into another fund, as the name suggests, way back in the US. If you use this, of course, there is merit. If you want to actually have money in dollar terms, then that fund is automatically hedged for the dollar. Because let's assume I put 100 rupees sitting in India as a Feroze, sitting in India, if I put in a Franklin Templeton US feeder fund, the 100 rupees is converted into a dollar the same day and remitted back there. So for an Indian, it's as good as a dollar asset every day. So if rupee depreciates, then it gives me a further appreciation because I had converted it to a dollar denomination on day one. So one advantage of that is it is dollar denominated. It can be a good diversification. Second is, I generally think that, of course, the US market over the last 2 years has done phenomenally well. So if I look at the rear view mirror, it is very, very pretty. So the returns will be very attractive for these funds. But I would stick to my home ground. to a large extent, because you have strategies to generate 13-14%, not as an exception. Last 2 years would be an exception there. You can make it for long periods of time. So I like to keep the money in India. Why? Because in the strategy which we do, even if Nifty delivered low sub-double-digit returns like 7, 8, 9, my portfolios can still make 12, 13. So that's why I would like to retain it. If for dollar denomination, I would rather hedge it back to dollar. So it's a good fund. It is for a person who is based in Dubai. It's not a complete no-no, but it's on everybody's context. But I don't think it is low cost, because there are 2 layers of cost. In fact, SEBI allows extra charge on these funds. There is a fund charge in the US. There is also a permissible 1.25 in India. So you can check that. So,
Okay, Mr. Rathi, the next question is coming for you from Mr. Piyush Jain. He wants to know how to keep the faith in Indian authorities.
Now, at least of late, we have been seeing a lot of governance issues. We talk about Yes Bank, we talk about ILFS, we talk about PMC. I'm not sure, whether this list is now only, or maybe Mr. Rathi, you've been seeing the Indian equities for a long, long time. Has it evolved, the corporate governance issue has become lesser, or to me it seems to be just too much?
Good question, Piyush. But I can tell you that, we should not be really guided by these what you're quoting are exceptions. I can tell you in last, ever since, SEBI came into being somewhere in 93, 94, okay, the time when I started this business. Actually, I was informal advisor while the SEBI rules were the act was being created. Dr. Dave was the chairman, first chairman. I think the governance standards have definitely improved in India. Sometimes it is said that regulators are going beyond a reasonable regulation. In fact, in past, I believe that many things, regulators, the intent is good. Okay, there is no doubt about that. The corporate governance standards have improved. And by and large, if you see, most companies have done very well. So I think few which have not done well must be taken as exceptions. Regulators are alert, but sometimes actually these instances push regulators to go to other extreme. My more worry is on that are we getting over-regulated? So I think squarely answering your question, standards have improved, but I think by and large, I would say that governance standards are improving. Companies with higher corporate governance are recognized by the market now, regularly. So please don't get worried about that, okay?
Mr. Jain, I hope you didn't wear a red shirt as a mark of protest. Okay. Okay, we have a question from Dhairya Jha.
My question is when involvement level as an investor is low, whether PMS or mutual fund, what should be our choice and what should be our decision? Thank you.
So PMS or mutual fund, if data has to point out, it should always be mutual fund. In 2015, mutual fund commission came down from 3% to 1%. That is when the PMS industry took off. For 15 years it was languishing. In 2015 April, from there the assets have grown up 25 times. That's because the differential commission was very, very large. To be honest with you, that's the reason why it is so popular and it's been given to you. Second is, why not a PMS? Those are all mutual funds, are all stocks. This is also a stock. But PMSs have a standard deviation. Like we said, 7.5 should be our target, 8 should be our target. PMSs have 22 as the standard deviation. 22. That's not acceptable risk to me as an investor or as an advisor for my clients. Because if I have to create a portfolio with 8 or 7.5 as standard deviation, if I put a small quantum of PMS, my risk crosses the limit.
And other considerations, obviously the tax impact is different between mutual funds and this, and also the accounting. In PMS, every transaction has to be accounted for. I think considering from all angles, cost to you, tax accounting, and ultimately, you can find mutual funds which are comparable to PMS. Now, it's always possible that some mutual funds do very well or some PMS do very well. I think one should consider the basic reasons why you should go for PMS or mutual fund. As I said, I think our belief has been that's the one reason as one of the large wealth managers, we don't have PMS of our own. We used to sell other PMS, which also in last 5 years we found that it's not in the interest of the investor. So we don't do that.
So we have one final question from Mr. Gurnani Jamna Das. I think you have a question on real estate, sir.
Say a company bought a land 40 years before. For example, 1 lakh rupees. Today market value I assess minimum 200, 300 times more within 40, 45 years. How the auditor in a company when they audit their books appreciate their value or depreciate the value? Is there any fixed percentage with the market ratio, with the comparison of the market, or a fixed ratio? One thing, if it is a fixed, what is the percentage they take?
I think, in accounting, normally there is no need to do revaluation of your assets. Actually, the accounts are supposed to show assets at purchase value. But some companies do resort to revaluation and then they tell the method. I think to judge any company, one should not look at the revaluation of this because as you said, there could be very different valuations. And particularly in real estate, the valuation is also linked to the liquidity of that valuation. You may have a price, but can you really realize that price at that point of time? So I think that I don't think in India people are in the balance sheets are revaluing their lands at all. They are shown at the purchase cost. And one should not therefore take a valuation, but yes, sometimes while buying a stock, it's like book value versus, people take book value as a yardstick of valuing. That when book value versus market value, the price is lower, people think that whatever appreciation has come in the assets is not accounted for. So that could be yardstick, but I think by and large, this is not relevant in most of the companies.
Gentlemen, thank you so much for being a part of this show and for answering so many of our questions. Do remember, if you have any questions, do write in to us at inquiries@investingedge.in. With that, we wrap up this special episode from Dubai. Do stay tuned to CNBC TV 18.